Hey guys, welcome to the channel and welcome back to another video. Guys, as you come in here, let me know that you can hear me by giving me a thumbs up and we're going to get this thing cracking. Our sole purpose today, our sole purpose today is to give a warning, and a warning to all investors that the stock market crash is really overdue. Okay. It's really overdue, guys. Um, and we'll talk about what a stock market crash is. We'll talk about PE ratios. We'll talk about all the stuff that is important for us to know as regular retail investors. So, as you come in, guys, let me know what city, what state, what county, what country, what continent, what region, what Milky Way, what planet that you're checking in from. Let me know in the chat section. And also, if you can hear me okay, give me a thumbs up real quick if you can, so we can know that you guys can hear me. And once I know you can hear me, I can take off this headset here, right? But let's have this conversation. What is a stock market crash? And why in the world am I giving this warning to all investors? Thanks a lot. I appreciate it, Frank. Hey, John is in Michigan. Good to have you, John. Appreciate it, Mrs. Reynolds. Why are we having this conversation about a stock market crash? Well, we're having the conversation about a stock market crash because it's been a while since we've had major movement in the stock market. And there's an indicator that I want to talk about on this video that is going to help you sort of think about whether or not stocks are overvalued and there's a potential crash coming, or if they're not overvalued, maybe they're undervalued. We're going to talk about it on this video because it's been quite a while since we've had a major shift in the stock market. It's really overdue. Art of War from Ohio State, good to have you here. Mia from Atlanta, good to have you, Mia. Who else we got in here? The Willie Wilo, good to have you here from Maple Shade, New Jersey. Good to have you. Hartford, Connecticut is in the house. Junior, glad to have you. Hebrew, Cheryl, two different minds pod. Peace and blessings to you too. Back at you. Cheryl's in Virginia, by the way. But the deal is, first, what is a stock market crash? A stock market crash, all it really means, guys, and there's textbook definitions for it, but it means a sudden double-digit percentage decline in a major index over a few days. That's what basically is the general conceived idea of what a stock market crash is. Nigel's in the house. Good to have you. Boss Life from Miami. Aretha's in St. Louis. Wilbur in Orlando. Good to have all you guys. California. See, Indiana's here too. Fantastic. So think about valuation. Let's think about the stock market and valuation. How are we valuing stocks? How do we currently today in the last, 6 months or so, year, 2 years, how have we valued stocks? Because the deal is a lot of crashes happen for various reasons, but one of the main reasons is overvaluation of the stocks that are in the market. Think of valuation of stocks as sort of like being like you have a car and you're buying a car, you're making payments on a car, and you get upside down on the car, and you owe money, you owe more money on the car than the car's worth, the value of the car. So you sort of, when you're upside down in the car, you sort of overvalue the car, and you sort of paid too much for it, because now this overvaluation that you placed on it, you paid $20,000 for a car, and you owe, let's say 20,000, right? You paid 20,000, you owe 20,000, but the car is only worth in the market 10,000, right? So you sort of overvalued the asset called a car, right? You place too much value on that car, and so you're sort of like in a bubble. We call it being upside down, right? This is what happens in the stock market, where the price of the shares of stock in general, overall, are really more than what they should be, right? So they're sort of in a bubble, right? It happens in real estate. We saw it back in 2006, 7, and 8 in real estate, right? Where homes were overvalued and people got upside down in their homes. They bought it for 200,000. 2 years later in 2009, it was worth 160,000. They were upside down because they overvalued the piece of real estate. And when that bubble burst, we call it a bubble in real estate. But in the stock market, so oftentimes we call it a crash, right? We see what happened in 2009 with the stock market. The market sort of corrects itself. You can overvalue a car, you can overvalue real estate, and you can overvalue stocks in the stock market, right? With a regular stock, you can place value on it. How do you place value on a regular stock? So, guys, by the way, as you come in, make sure you hit the thumbs up button. But you might want to share this video. Be thinking about somebody who might want to hear this information about stocks. We're gonna hit some things that's really important, especially for, say, beginner or intermediate investors. That you may want to share it with them. Share the link to this video with them, right? But with a regular stock, you can place value on it by what? Looking at either earnings per share, or what's the other one we look at? PE ratios, right? Earnings per share, PE ratios. And that's just one indicator of whether or not a stock is overvalued, right? If you think about, I'm going to dig deep here just for a second, guys, bear with me. So if you think about earnings per share is basically a company's earnings, or their profits, or their net profit, or their net income in the past 12 months or so, divided by, this is earnings per share. It's their profits or net income divided by the company's total outstanding shares of stock, right? So with earnings per share, we're talking about how to value a stock right now. And I'm going to translate this over to the stock market. But how you value an individual stock, typically you look at earnings per share, right? That's the net income or profits divided by the company's total outstanding shares. Now, the higher the earnings per share, EPS, whatever they call it, EPS, then the more likely that the company is strong enough to pay their dividends and everything else they have to pay and stay afloat. That's earnings per share. So we look at earnings per share a lot when we see a stock, right? You can get the EPS anywhere, yahoo.com, google.com, or Yahoo Finance, whatever. So that's one way we look at earnings per share, right? Now, the other way is PE ratio. I'm sure you guys have heard of the PE ratio. That's just taking the price and dividing it by that earnings per share. And it's PE ratio is one of the most common ways to assess an individual stock, right? When it comes to valuing a stock and basic stock market information, the PE ratio is typically pretty crucial. It's a figure that people kind of look at pretty close, because it measures, basically, a PE ratio measures basically how much an investor is going to be making per share, per each dollar that they invested in the stock. The P is the price, the E is the earnings per share. So it's P over E. It's price over earnings per share, right? So while you want your earnings per share to be high, you want your PE ratio to be as low as possible. The lower the PE ratio, typically, here's the general way of looking at it. The lower the PE ratio, the more the stock price is undervalued or valued fairly. Okay, I wish I had a whiteboard behind me here. Okay, if I had a whiteboard behind me, just imagine this. Current stock price is $100 per share. The earnings per share is $5. So that means you're paying $100 per share of the stock to get a piece of, or to claim, $5 of earnings per share. $5 out of that $100 as your earnings. That's what earnings per share is. So if we take the same $100 stock price, I should be writing this out. If we took the same $100 stock price and divided it by that earnings per share of $5, you get a 20, and 20 is your PE ratio, price over earnings per share, right? So, under 10, this is the rule of thumb. Under 10 or 12, around that, you say, okay, the PE ratio, the stock is undervalued. Undervalue is good, because you want to buy stocks undervalued. That's like buying them on sale. Fairly priced stocks are somewhere between a PE ratio of 12 and 19, 12 and 20. That's kind of a fairly priced PE ratio. And then an over a PE ratio that's too high is going to be in the 20, 25, 30 range, right? 40, 50 range. But I got to say this, I can't leave a discussion about PE ratios, and I'm going to tie this into why the stock market is overvalued in just a moment. But it depends on the sector. So when you look at the tech stocks, and I challenge you guys right now on your phone, go to Yahoo, go to Google, pull up a stock and look at the stock's PE ratio. If you pull up a tech stock, let's say a Nvidia, you pull up an Nvidia PE ratio, you're going to say, wow, that PE ratio is way up there. Yeah, the PE ratio for tech stocks is way up there because tech is a sector that's considered a growth sector, right? So tech is a growth stock. It's a growth stock, growth sector. It's expected to have incredible growth. So the PE ratios are high in the tech sector. Now you go back to, let's say, a value stock like a AT&T or Procter and Gamble, or something that's been around for a long, 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 long time and is very stable. Coca-Cola, right? When you look at those stocks, they usually run lower PE ratios, right? Look in the oil industry, the oil sector. Look at ExxonMobil and Chevron. You'll see their PE ratios are fairly low compared to, you know, TSM and Nvidia and Broadcom, right? So now you don't have to typically do all this stuff yourself when you're trying to value a stock, because you can just go to a website and pull it up, right? That's valuing stocks. That's one measure of valuing a stock, using quantitative stuff, numbers, the financials. However, remember, there's variables that come into play when you value a stock, right? You don't want to use earnings per share and PE ratio as the sole determining factor of making a decision about buying a stock. That's just one factor, right? One or two. Now, let me tie this whole conversation into my warning to all investors why a stock market crash is overdue. Okay. When you look at the big picture of whether or not the stock market is overvalued, because you can apply this stuff to the entire stock market, not just a single stock. You can look at the PE ratio of the entire market, right? When you first want to see whether or not the stock market itself, the overall stock market, is operating in a bubble or it's valued too high, there's several ways to go about it. But one way to go about it is to look at the PE ratio of the overall market. Look at the PE ratio of the overall market. Now, historically, guys, when we're talking about the stock market, the PE ratio of the overall stock market is one indicator of overpricing or overvaluation in the stock market in general. When that PE ratio of the overall stock market is too high, it's indicating some issues, right? And you can find the PE ratio of the entire market by looking at the benchmark. What's the benchmark? The main benchmark, the main cornerstone that we use to evaluate the entire market is the S&P 500, right? So what is the S&P 500 PE ratio right now, or in the last 5, 10, 15 years? Remember, typically a PE ratio of over 20, over 25 is about the top of where you want to be with single stocks, generally speaking, depending on the sector, and with the overall S&P. Also remember this. I just told you that tech stocks run a higher than average PE ratio, right? So you got to keep that in mind when you look at the overall PE ratio of the S&P 500. Let me share my screen with you guys real quick here. Let me look up, and here's how you can figure this. Let me show you this real quick. I'll see if I got it up here. Bear with me. I haven't even looked at the chat. Man, I just get to rolling and get going, guys. What can I say? Angie, good to have you in here. Let's see. If Nvidia misses earnings, all tech stocks will tank. Yeah, you're right. But if Nvidia beats earnings, right, what's going to happen then? We know it's going to be crazy, crazy, and it'll shoot back up more than likely. But let me share this screen with you guys real quick. And I want to show you what the PE ratio is. And I'm going to drop myself back down. Appreciate you guys being here, by the way. Make myself small. Man, that's too small. You guys can barely see that, right? So this is a chart of the PE ratio of the S&P 500 since 1880. A long time, right? Since 1880, right? But here's what I really want to focus on. I really want to focus on this second half over here. And I wish I could make this a little bigger, guys. But over here, 2000 to 2024, where we are right now, as we speak right now, the PE ratio of the S&P 500 is about 27. And it's been over 20 since about, it dipped down one time under 20 in 2018, but it's been over 20 since about 2014, 2015. And it hasn't, and this big old spike we see right here was in 2009. We know what happened in 2009 with the stock market crash, the real estate crash, and all that stuff going on. It spiked up to 123 as a PE ratio. So what you notice here, guys, is since say like it's been hovering above or over 20 for the last 20 plus years. It did have some years where it went down. But just take a look at least, let's say, the last 10, 12, 15 years right here on this end right here. The PE ratio has been up at over 20, 24, 23, 22, 24, 27 now. It's been sort of high. Now, one reason why the PE ratio has been sort of high for the overall S&P is because what has been driving the S&P in the last 10, 15 years? What types of stocks have been driving the S&P? Tech stocks. And what did we say about tech stocks? Typically, listen, right now today, 30 to 35%, let's say 35% or so of the S&P 500, let's say you own VOO, VOO, right? The ETF that has the S&P 500 inside of it, the bucket of stocks called the S&P 500. If you owned VOO right now, about 35% of the weight in that bucket of those ETFs in the ETF called VOO is tech. We're very, very tech heavy. And so as tech goes, sort of the S&P goes, right? And so when we try to make a look, when we look at the S&P 500 PE ratio, there's a large weight of that that's driven by this high PE ratio sector called tech in the last 15 years or so, right? So let me close this out real quick. Boom. I always got to talk myself through every action I do here on the screen, guys. So bear with me. And let me look at another one real quick. Let me pull up something else. So I'm trying to point some things out to you guys about why. Oh, let me show you this too. This is important for you guys to know and note. PE ratios have the PE ratio of the S&P 500 historically has an inverse relationship with the Fed funds rate, what we call interest rates. So typically over the course of 120 years or so, the higher the Fed funds rate, the lower the S&P 500 PE ratio. The lower the Fed funds rate, the higher the S&P 500 PE ratio, right? I'm just giving you things to think about as an investor, as a person that needs to know what's going on with their investments and understanding the stock market a little clearer. Now, I'm sharing this one with you guys. Let me see. Yep, you can see it. So, I don't know if I can't make it bigger. This is generally up until about 2018, 2019, the historical look, say from 1971, of the relationship between interest rates in the yellow or orange and the S&P 500 PE ratio in the blue. That's that big spike again right here, right? So as you see, typically throughout the 70s and 80s and parts of the 90s, beginning of the 90s, and even into the late 90s, and even right here into 2001, 2002, and here as well into 2010 and 13 and 15, when interest rates, that's the Fed funds rate, when they are down in the brown, in the orange right here, orange brown, S&P 500 ratio, PE ratio is up. And when the Fed funds rate goes up, right, the S&P 500 PE ratio goes down. Remember, a down PE ratio is when stocks are undervalued or they're valued fairly. And a high PE ratio is when stocks are overpriced. What do you notice about the end of the teens, the 2020s, or before we got 2020, right? PE ratio was up. What was going on with the interest rates from 2010 to 2020? Interest rates were at historical super duper 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 low lows. And when interest rates, Fed funds rate is at super duper 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 lows, and you have the tech industry, tech sector driving the market, there's a possibility for overvaluation. There's a possibility for us to be putting too much value into stocks. And what happens when you put too much value and you overvalue something? Ultimately, it has to come down. Sometimes it'll come down crashing, sometimes it'll come down slow. But it's like when you're upside down in your car, right? You owe more than it's worth. So the tech industry, which is carrying the big weight of the stock market over the last 12, 15 years, is also a very volatile, cyclical sector, right? I'm just trying to put you at ease a little bit. When you see what's going on, like right now in the tech sector, right? Right now in the tech sector, we see, a lot of volatility. There's no need to panic. This is what happens. But it's also an indication that the market is overvalued, right? Remember, a high PE ratio is oftentimes throughout history considered a sign that stocks are overvalued, which can obviously, guys, increase the likelihood of what's called a market correction or a crash. Correction being 10% drop, textbook version, crash being a 20% drop, textbook version, right? So there's an inverse relationship. Right now, the historical Fed funds rate is right around 5.3 or 5.4%. Right now, we're right at the historical average of interest rates between five and a quarter, the Fed funds rate between five and a quarter and five and a half. So when we see the Fed funds rate start going down here shortly, Fed will probably start lowering rates at the end of this year, right? When we see them go down, it means that usually supports an overvalued stock market. When the Fed funds rate goes down and down and down, and then we're in the threes and we're in the fours, that usually indicates an overvalued, overcushioned stock market. What does that mean? It means that we're probably going to see a correction soon. I'm sorry, a crash soon. If I went back to the chart that I showed you and we looked at 1929 stock market crash, before the crash, the PE ratio was high. Of the PE ratio of the S&P 500, the total market was high. Boom, stock market crash. You look at 2008, 2009, or actually look at 1999, 2000, when you had the dot-com bubble. The bubble burst. PE ratio soared. It was really high, right? Because it went way up. People start overvaluing things when they start speculating. And when you have technology, a new technology in the year 1999, 2000, everybody was making a guess. Everybody was speculating. And we started overvaluing the price of stocks. Guess what happened? There was a crash, right? Financial crisis of 2008. Now, the PE ratio, I think if I look back on the chart, the PE ratio in '08 wasn't super duper high, right? But we had other factors like the housing bubble that was taking place as well. And it led to a lot of financial instability. Market crashed. Where are we at today? 27, fairly high PE ratio, over reliance on tech stocks that may be at a bubble. And we're seeing them starting to come down right now, right? In the last couple weeks, 3 weeks, month. But we haven't had a crash yet. This is why I'm telling you a crash is overdue. It's my warning to all investors why a stock market crash is overdue, right? Something to think about. Think about Nvidia. Nvidia was at what, 140, 139 or something about a month and a half ago, a little over a month ago, right? It was overvalued. If your stock is selling at 140 and you know there's been everybody's big frenzy around it, what are you going to do to the stock that you bought at 139? I'm not on with it. The stock that you bought earlier, let's say when it was 190, 80 on the way up. What are you going to do when it reaches 140? And you know that it's probably overvalued. Then you're going to sell, right? Remember, the stock game is all about buying low, selling high. When things get too high and overvalued, they're going to sell. Think about it like with that used car. The used car salesman who sold you that $10,000 car for $20,000, he's going to let that thing go up as high as it can, then he's going to sell. When it's high as it can be, he's going to sell. He's going to get rid of that asset so he can make some money. And every time he makes money, you lose money. So when the perception of overvaluation is out there for investors, investors want to sell high and scrape profits off the top. That's what the stock market's all about. I mean, we'll just read in the chat here. We buy low, we sell high, right? You got to keep that fundamental thing in your mind as long as you're in the stock market, because it explains much of the movement that you see in the market. Buy low, sell high. The other thing to think about is how do investors feel? Because we're human beings, right? And so how do we feel makes a difference. When PE ratios are high, there's a lot of optimism. Like I said earlier, there's a lot of speculation, right? Everything's going great. Woo, Nvidia, woo, went way up. Speculation's high. And as soon as that sentiment shifts and everybody feels a little bit different, it triggers sell-offs, panic. I got to get rid of it. Oh my, man, I bought it at 120. Now it's at 100. Oh my goodness, what do I do? Panic. And when you panic sell, you typically sell low. You buy it and you sell it low. Instead of buying low and selling high, you buy high and end up selling low because you panicked. Right? Also, we got to look at some of these big, broad economic developments around us, right? High PE ratios. Okay, let me explain it like this. When you have high PE ratios and everything is going good in the economy, everything is great like it was from 2012 to 2021, the chances for a crash are a little lower because the economic conditions really don't support it. We support a crash, right? However, when you see high PE ratios in more of a fragile type of economy, things can be a little more dangerous. And listen, our economy today, while it's still fairly good, there's also a little bit of a hint of fragility in our economy today. Unemployment going up. GDP is going down, right? GDP, overall production, basically. GDP is going down. Unemployment's going up. As I say all the time, we have a presidential election coming in. We have a possible war over in the Middle East. We have another war, which if you want to consider it a war, over there in the Middle East as well, right now between Israel and the Hamas, right? That stuff is going on. Iran may get involved. Now you got Russia and Ukraine. Then you got some tensions between Taiwan and China. all these things happening around us, and you got the Japan markets that went crazy a couple of days ago. So it's a lot of fragile stuff going on in the economy. So high PE ratios in a fragile economy is much more dangerous, right? Much more dangerous. So we're in a fragile economy. So a high PE ratio right now, as of today, means there can be some danger around the corner. Look, the stock market does not like uncertainty, issues, problems, worldwide panics, and things like that. That's a problem. Why is it a problem? Because who wants to have their money in the stock market that may be tanking? I'd rather move my money over to bonds, like my man Warren Buffett, right? Did you guys read the story today about Warren Buffett having more T bills, owning 200 something billion dollars worth of T bills that are getting 4 or 5% right now on those short-term loans, short-term bonds? He has more T bills than the Federal Reserve has bonds, right? I mean, why is he moving into bonds like that? People move into bonds because when they see some issues in the market, instead of taking the 10%, the negative 10% hit in the market, they'd rather go over to bonds and get a 3% return. It's a better trade-off, right? So high PE ratios, high PE ratios, a couple of more bad tech earnings reports, let's say in August, late August, what would that do to the tech sector? Right? Could see that big old 10% or that big correction, big crash, and tech is 30% of the S&P 500 or more. So if 30% of your S&P 500 fails or dips significantly, it could have a major lasting effect, right? The PE ratio of the overall stock market is just one factor that you got to look at if you're trying to figure out if the stock market's overvalued or not, right? Keep in mind a high PE ratio is bad, right? You want your PE ratio to be as low as possible. That means it's undervalued. The lower the PE ratio is, the higher it is, the more overvalued it is. And you'll see higher PE ratios when you're looking at growth stocks or growth sectors like tech that has volatility and it's cyclical, goes in cycles. Now, PE ratio is not the only determining factor, right? We know that. There's other factors, right? All right. But think about, okay, why? Let me see if I got the chart up here. I got another chart I want to share with you guys. Nah, I won't share it. I'll just leave it. So tell me why. Well, let me look at the chat. I haven't been to the chat in a while, guys. Let me go to the chat. Let's see. We got validated. You guys are lively chat. Lively chat. Appreciate you guys in the chat. Lively chat. Appreciate it so much, guys. Let's see. Validated's in here, of course. Walamala's in here. Breeze. Mrs. Moore, thank you for being here. Guys, do me a favor and hit that thumbs up button. You just take out 2 seconds out of your moment and walk down to the bottom of your TV screen, your mobile phone, your laptop, whatever you're on, tablet, and tap that thumbs up button for me. I really, really would appreciate it. What we try to do here, guys, at least throughout the week, oftentimes on Wednesdays, Thursdays, sometimes Mondays as well, is try to give you guys, as beginner investors and intermediate investors, things to learn and think about when you're trying to be involved and make more money in the stock market, right? Because we want you to make more money. We want you to invest more money, make more money, compound more money, get more dividends. We want all that stuff, right? So the key is to try to do as much, give you guys as much as I can about some of the things that I know and understand about the stock market. Also in the description box, guys, check out my partner on this video, Mint Mobile. If you have Mint Mobile, let me know in the chat. I like it. I've had it for 8 or 9 months, maybe 10 months now. Works out great, works out well, and it's very, very inexpensive for a premium wireless service that uses the largest 5G network. Yep. So check them out in the description box. There's also the free ebook down there, The 24 Laws of Money, that helped me build my wealth from nothing to something, right? There's also in the description box, if you want to get a hold of me, you want to do a one-on-one, you want any of that, if you want to, you can look in the description box as well. If you're on LinkedIn or Facebook and you don't see that stuff in the description box, go on over to YouTube and you'll see it over there. So that is super important. Wanted to get that out the way, a little house cleaning. And thank you so much again, Mrs. Moore, for reminding me about that. All right. So S&P 500 ratio, I'm sorry, PE, price to earnings ratio, relatively high over the last 15 years or so. Why? Why has the PE ratio been relatively high? Again, tech stocks, huge, been carrying us for since about 2012 or so, been carrying us, right? But also at the same time, we've had low interest rates up until about 2021, 22, right? We had really, really low interest rates. They kept the interest rates low really since 2010, right? Since that financial crisis of 2009, the Fed has kept it super duper low, right? And low interest rates usually call for higher S&P, higher valuation of the S&P 500, right? Of course, there was QE. We got QT right now, but we had QE where the Fed was doing this what they call quantitative easing, right? Right, which is the large scale purchase of fixed assets. What is the fixed asset that the Fed was purchasing all the while? They were doing quantitative easing. Yeah, they were purchasing bonds. They purchase again, I said it before, I'll say it again. They purchase bond. They create money out of thin air. And then they go purchase a bond. What is a bond? It's a loan. So the Fed would go pay for bonds and they would pay for the bonds in the cash that they created. And what did that do? That put more cash out into the economy and made the economy more liquid, right? And when you put more cash out into the economy, of course, you devalue the dollar, but you also increase the prices of everything. And that's why we had all of the quantitative easing that was going on from 2010 to 2021, right? And that was one of the factors that led to the large inflation we saw in 2022 and 2023. And so the Fed went out and purchased fixed assets called bonds, injecting cash in the cash they created out of thin air. I don't think people really understand that. They think I'm just making it up. The Fed prints the money out of thin. They don't print the money, but they order the money to be printed out of thin air, and they use that money to go buy bonds that puts more cash into the economy. And when more cash is in the economy, like more cash in your hand, AKA stimulus checks, more money in your hand, more money in the economy, more money, more cash in the banks to loan to you. When all that's happening, it's going to make the price of everything go up. And that's why we had this, like I said, large scale inflation. Because of now, what they do, instead of quantitative easing, putting money out into the economy since 2002, they've been trying to take money out of the economy. What's the one way that they can take money out of the economy? Raise the interest rates to deter you from going out and borrowing money, and deter businesses from going out and borrowing money. So now we raise the interest rate, and now you got to borrow that money at 8, 9, 10%. And now you're not going to go borrow money. So ultimately, that's going to reduce the amount of money in the market, in our economy, right? Because now they're trying to reel back that quantitative easing with what they call quantitative tightening. Too much right there, I know, guys, but it's just, I'm flowing, right? So sometimes I get going, but you don't have to know all this, right? But you just got to pay attention to what's going on around you, since you want to be a seasoned, informed, intelligent investor, right? Then, of course, we had the pandemic and all this stuff. My point is this: warning to all investors. This is why a stock market crash is inevitable. It's overdue. It's going to happen, right? Probably sooner than later. We really haven't had a big crash. We would have had one, but the Fed sort of prevented that right at the start of the pandemic by lowering rates very, very low. So to stimulate people out there spending money. Right. That was the whole point of them injecting cash into the economy so that people would spend money, even though they were sitting at home 23 hours a day because of the pandemic. Right. It just sort of flowed over into it, and they knew it would flow over, and they knew it would create inflation. These are smart people. They know what they're doing. Right. Let's see what we got in the chat. The markets are rigged. It really comes down to when they want it to happen. The Walla Mala, they're the puppet masters, and we're the puppets, right? We kind of move as they move. And I did a video a few weeks ago. I said, "Hey, look, you don't have to do what they want you to do when they want you to do it. You just got to think a little deeper about it, right? Just think a little bit deeper about it." So I really just wanted to share this with you guys to say, hey, you need to have your head on a swivel, paying attention to what's going on. You don't have to watch the stock market every single day, especially since a lot of you probably have ETFs. And if you have ETFs, you don't have to sit around and watch the market all day to see what happens with this and what happens with that. Oh my gosh, and get all nervous and get all stressed. You ain't got to do none of that, right? You ain't got to do none of that. Let's see. Somebody said Gold Ambition. I like that comment. Gold Ambition said Nvidia is still the same company. He kept going, but I'll cut it off right there. NVIDIA is still the same company that you were hyped on a month ago. The only difference is it was a little bit overvalued, right? You sort of bought the car called NVIDIA for $20,000 when it was really worth about $15,000. But you bought it for 20. Now, this is why you buy stocks for the long term. If you hold on to NVIDIA, just chill, relax, maybe use this time to buy a few more shares. There's a possibility that this time next year, I'll be doing a show about how NVIDIA went over the $250 per share mark. That's a chance. I mean, it may not happen, but maybe it could be at the $175 mark, right? And tech could be rebounding. Or I could be doing a show this time next year and the bottom fell out because there's a stock market crash led by the overexuberance of everybody's hype on AI and tech stocks. We just don't know. We really just don't know that, right? And I'm not here to tell you that I know it. I have a crystal ball, and I'm going to give you all the right. Listen, I'm just like you. I don't know. If I knew that, I would be, a billionaire, right? But I don't. This is not financial advice, or not. This is not stock market advice. This is just information. This is my heads up to you to be looking for this because of this PE ratio that has been above 25, 20, 25, 30, hovering in that mark for quite a while. And there's been an over reliance on tech, an over reliance on these volatile cyclical stocks called the tech sector. You could name them all, right? Let's see here. Please, Omanika, I hope I got that right. Smash the like button for me, guys. Please hit that like button, share the link to this video, or also, hey, if you're not a subscriber, please consider subscribing. Please, please, please. Thank you, Clint. I appreciate you. Robert, I appreciate you too so much. So limitations. Let me just give you guys a few other important things to think about. The PE ratio of the overall stock market is not the only indication of overvaluation of the stock market in general. Okay. Always keep in mind that companies that have high growth rates are going to have a high PE ratio, and they're going to look a little more overvalued because there's more speculation going on about them. People are speculating on NVIDIA's future. People aren't speculating on Coca-Cola. They know what Coca-Cola is and what it's going to do. But when your S&P 500 is top heavy, meaning that tech carries most of the weight, then the stock market is going to see volatility. And that's going to increase the possibility of a stock market crash, right? Remember always, economic and market conditions, it's important to consider what's going on in the broad market. Let me say this too. Tech stocks are more affected by global economic things happening around it. Tech stocks are more affected by geopolitical conditions, right? So you got Nvidia, and you have to remember that the fate of Nvidia rides on the relationship between China and Taiwan, the political relationship between China and Taiwan, and between America and China, right? So these tech is worldwide, right? Listen, whether there's a war or not a war, everybody gonna be drinking Coca-Cola, right? Whether there's a war or not a war, everybody gonna be using AT&T, Uverse, whatever. Whether there's a war or not a war, some things that you buy. This is why when you buy individual stocks, you need to be looking at the sector of the stock. Whether it's food and the consumables, whether it's industrial, whether it's manufacturing, whether it's oil, whether it's energy, whether it's utilities, you need to be thinking about the permeability, of the sector. Can the sector withstand a war somewhere? Can the sector withstand another pandemic? And these are the things that you need to be thinking about to make your decision, not whether or not Jim Cramer says buy a stock, not whether or not MSNBC had a good article and a good write up and they were featured on 60 Minutes. Look, that stuff doesn't matter. But the stuff that really matters is how stable, how volatile, what's the risk? Right? All these things matter more. Market conditions, economic conditions, these are things to think about, right? There's other ways, like there's the Shiller PE ratio, there's the Buffett indicator. I think Buffett, let me look that up real quick. The Buffett indicator. Let me see if I can't pull that up real quick of how to see whether or not the market is overvalued. Here it is right here. The Buffett indicator compares the value of U.S. stock market to the size of the GDP, dividing the total market cap by GDP. If the stock market value is growing much faster than the actual economy, then there may be a bubble. I just pulled up the Buffett indicator to see if there's a possible crash or bubble or if stocks are overvalued. So there's other methods out there, right? Looking at the PE ratio of the S&P 500 is just one. Always keep this in mind, guys. Always, always, always keep this in mind. Let's see. I'm going to go back to the chat here. Okay, we still have our stock, but at a cheaper price. There you go, Bruce. I like the way you said that. Let me highlight that. We still have our stock, but it's just at a cheaper price. That's the way to look at it, right? You don't lose money until you sell it. Right? Good point, Bruce. I appreciate you saying that. Nvidia has already mooned. Nvidia is no longer the avenue for the ultra rich to get more of your money. Let's see. Euphoria strike, but that does. I'm just reading some of the chats here. VU is on sale too. Absolutely. VU is the S&P 500. Somebody said seasonality plays a huge part. August, September. Listen, very good point. September, October, worst months. Right? Most bearish months. Thanks for saying that. You also have to triple witching this month. Check out the data charts, the market, all that good stuff. Right. But keep in mind, I think it's October. Is it September? October is historically the worst month. Right. Yes, we are very heavy in tech. Thank you so much, JT Coin Rings. I appreciate you so much, man. Thank you for rocking with me on the road to 150,000 subscribers. Thank you so much. Yeah, we're close. We're about 100 shy. But I appreciate that. Thank you, JT Rings, so much for rocking with me. Let's see here. Just going through. Uverse is still a thing. Yeah, I had Uverse myself for a while. I did not like Uverse. My goodness, that was horrible. Always going out. I think it was at the beginning of Uverse when they first came out, 15, 20 years ago or so. Let's see. Yeah, Buffett has large influence. NVIDIA is a great company, but it was all FOMO. They make a great graphic cards for gaming. It's not that it was all fear of missing out. but there was a little bit of what they call irrational exuberance, right? People just jumping on the bandwagon because for the most part, let's be honest, right? For the most part, most of us are like sheep, right? When one person turns and starts going this way, we all kind of turn and go this way, right? We kind of just kind of follow the crowd, so to speak, in a lot of ways. So it was a little, I won't say it was just FOMO only because NVIDIA is a company that has fantastic fundamentals and it had historic growth. But at the same time, I guess you could call it FOMO. People were just sort of piling on and piling on, and they drove the price up, right? But it's back down to where it should be at. What did Nvidia close at today right now? 98 bucks and 91 cents. No, 98 bucks and yeah, 98.91 or 98.95, one or the other. That's where it closed today. Under 100. So, look, if you still believe in AI, boom, you got you a pair of Jordans on sale for 40 bucks right now. You got you a 200 pair of Jordans on sale for 40 bucks. You got a Gucci purse that costs $700. It's on sale right now for $150, right? If you're a believer in AI, if you think the company has such fundamentals where it's going to do well, you've got yourself a huge sale. We're talking TSM, Broadcom, you name it. AMD, I think AMD is still trading pretty low. Jay said 97.60 after hours, pretty low. Listen, here's the deal. One, make a plan. Stick to that plan, whatever your plan is. Two, commit to consistency. Three, invest the money that you can afford to lose so you don't have to trip on it and you don't have to worry. You don't have to be stressed out because it's money you can lose and you plan on being consistent over a long stretch of time. Four, only invest in what you know. If you don't know tech, don't be messing around in tech. If you don't know utilities, don't be messing around in utilities unless you learn about utilities or unless you learn about tech, right? If you learn about it, I'm cool with it. But just make sure you're investing in things that you know, not things that look shiny, right? The $20,000 car looked real shiny, but you didn't know nothing about cars. So you got, and you paid $20,000 for that car when that car, if you knew anything about it, you would have known that it's worth $10,000, $12,000, but you didn't. You don't know anything about cars. It just looked good, right? They had the rims on there. They had the fat tires on there. They had the interior, right? First thing you do, you get inside the car. What do? You turn the radio on, right? As if the radio matters, right? You sit there, you test driving the car, and you want to see how loud the radio get. The radio means nothing, right? So you overvalued paying for the car because you don't know nothing about cars. If you had just looked under the hood, you would have saw oil everywhere. But you didn't. You didn't know what you were doing, and you got. This is why you got to make sure you know and understand the industry that you're investing in and the company that you're investing in. Otherwise, don't do it. Make sure you diversify. That's number 6. No, that's number 5, I think. Diversify. Please don't have all your eggs in NVIDIA. Please don't have all your eggs in Broadcom. Please don't have all your eggs in one place. You can separate your stocks into sectors, separate your stocks into value versus growth, separate your stocks into cyclical versus non-cyclical, whatever you want to do, however you want to separate them. But make sure you diversify so you don't get hammered because you just took a big old chance and a big old guess and a big old speculation on one stock, right? 6th thing, consider reinvesting dividends. I know everybody doesn't do it. I like to do it. And then finally, number 7, don't panic. Relax. Not a big deal, right? Not a big deal. It happens. Tech stocks go down, tech stocks go up. S&P 500 PE ratio kind of goes up and down, kind of with tech nowadays, right? Right. But understand that a stock crash is coming. This is my warning to you. We haven't had one in a while. But these are some indicators that you need to be paying attention to as you're looking. Somebody said I've had something since 2017. Is that Nvidia? Let's see. Johnny GG, listening, watching your content, great learning experience for sure. Trying to stay consistent and think about the bigger picture. Absolutely, Johnny. Appreciate you being a subscriber, man. Thank you so much. Let's see. I'm scared. Don't be scared, Joe. I'm scared. That's in case you guys don't know. That's scared for St. Louis, right? If you're from St. Scared, right, or even some other parts down south, right? The PE ratio or fundamentals of the company has nothing to do with the stock price. All is lies. The criminals pump the market up. Now it's time to slather the sheeps. Okay, Anna. All right, I'm not mad at you, Anna. Let's see here. So what I need you guys to do is a couple things just for me. Okay, just for me. Pouring out some stuff to you. I need you to hit the like button for me. I need you to subscribe to this channel if you're not a subscriber. And I need you to share this information with somebody who you think is a new investor or who wants to get invested, who's thinking about becoming an investor, who wants to be a better investor. Thank you, JT. Again, so I want you to share this information with that person, right? Just the link to this video on YouTube, just share it, right? Or if it's a post in LinkedIn or Facebook, share it with somebody else, right? Whatever you can do to share this information as many people as possible. That's who I want to have this information, right? So, hey, I'm not going to hold you guys. I appreciate you more than you know. Thank you so much for tuning in. I got some other videos that are dropping. One dropped today. Great video. Gosh, that was a really solid video. Please check that out. Go to the video section, check it out. But also, I got another one coming tomorrow morning that's going to go a little deeper dive, and I'll be back at you guys tomorrow evening with another live. All right. Again, Mrs. Moore, I thank you so much for helping me out. Dance Hall, Robert, Malik Ware, Big Boy, Ruben, Anna, John Joe, Gold Ambition. I appreciate you guys being here. Thank you so much. As I always say, the best person to take care of the old you is the young you. Guys, take good care of yourself and take care of other people. Until the next video, peace.